further ado, I'd like to welcome to the stage, the virtual stage, Rebecca Kaden. Rebecca, how are you today?
Thank you for having me. I'm so excited to be here.
So honored to talk with you. And I was sharing with you earlier that you were one of the first folks that I learned about in the All Raise community when I first joined. And so it feels like such a full circle moment and such an honor to talk with you. Before we jump into it, Rebecca, though, I want to talk a little bit more about your expertise. So, of course, you're currently the general partner at Union Square Ventures, but you began your career in journalism, which I think is such a fascinating and applicable skill set. So I'm excited to dig into that. Prior to Union Square Ventures, you were a general partner at Mavron, which is a great firm as well. Lots of people there, friend of All Raise. And they're consumer-focused early stage fund where you were doing some things over there too. And of course, you're a New York City native. You studied English and American literature at, and wait a minute, remember Beyonce was talking about her, Harvard, and you received your MBA from Stanford. So you've been doing some things for some time. And Rebecca, before we talk about all the things in the industry, we want to get to know you better as a person. And so I'd like to start with your transition actually from journalism into venture capital. Why did you make that change? And what skills do you think from journalism you still use in your job every day?
Yeah, well, whenever journalism comes up, I always say, thank God for Mike Moritz, who, is one of the legendary investors at Sequoia, and he was a journalist. And so he's the kind of, because of him, it's that makes sense as a path into venture. Without him, we'd all be, screwed. But because of him, it's a tried and true path. There are actually some others really, really awesome journalists turned VCs. Catherine Boyle is one. There's a bunch. But I studied English. I loved writing. I spent all of college really kind of debating between wanting to go really in a more academic path around literature or a more journalistic path. Did the latter for a little bit, did both. And then wasn't really sure what I was going to do. And so went to business school, which is something you do when you're not really sure what you're going to do.
Business school people, look out. She coming for you.
Sorry.
She's like, if you don't know what you want to do.
Actually a great idea if you don't really know what you want to do. And when I was there, I was at Stanford and I became very close with a mentor there who was a guy named Bill Campbell. Bill Campbell passed away a couple of years ago, but he was kind of a legend in Silicon Valley. He was on the board of Apple. He was on the board of Google. He ran Intuit, and he mostly spent his time with kind of big name, important people. And then kind of all the way on the other side, he taught at the business school and was really renowned for spending time with the students there and really getting to know people, which was his brand. He was called the coach in Silicon Valley. He was a tell it as it is personality, which I really admire. He wasn't about kind of showmanship. He was about action and about transparency. And I always super admired him. And he and I became close, and I was trying to figure out what to do. And he said, I think you should be a VC. I think, that would work for you. I think your people focus and actually your experience as a journalist would lend itself well. I can know now why that might be the case in a way I couldn't know then. But, as a journalist, you're trying to piece together stories, right? You're trying to figure out narratives really with more data points and facts that you probably need and less than you would ever like. You're trying to become the go-to source, right? Who do people call first? Who can they trust? Who can you develop relationships with so that they're going to tell you the story first? That is all actually very, very similar to investing. The output is wildly different. Some of the risk factors and the decision-making is different, but the people orientation and the narrative orientation between journalist and early stage investor, I actually find quite similar.
I love the parallels that you've drawn. And I also want to call back, you talked about this mentor, and also other people who've transitioned from journalism into VC, making it a tried and true path. And I just wanted to call out, I think you're also making it a tried and true path, right? You're one of those people who is showing folks the way. So I just wanted to call that out because it's one of the things that I talk about when I talk about you. I have my Rebecca Kaden talking points that I use when I'm out in these streets. What geeks you out about VC? Like what still gets you excited about this industry?
So many things. Honestly, the community and the people is a big one, including the All Raise community, which has been, invaluable for me from a professional perspective and also a fun perspective, which I think both matters quite a lot. What geeks me out the most is that we're in, our business is technology. I'm a software investor. I spend all of my time thinking about how software and businesses can make things more efficient, more effective, more valuable. And yet the core of what we do is extremely people-oriented. It's all about humans. It actually has very little to do with technology. Building a company is a very, very human thing. It's about managing people. It's about taking risk. It's about kind of balancing ambiguity and big vision with this detail orientation. Anyone, when I talk to my CEOs about it, the software and the product is the thing they worry about the most at the beginning. And over time, it's often the thing they worry about the least. And that dichotomy fascinates me. And the people-ness of this whole thing really keeps me going.
I could not agree more with you. And I love that, it's interesting. You start thinking this is all about software. It's all about the business model. But at the end of the day, it's about the people building it, the people you're serving. I love that. Okay, great. My last question for you. It sounds like you have a lot of great mentors. Do you have any other mentors that you feel like have really helped you achieve success in your career?
I have lots. I'm a big believer in mentorship and, sucking it out of anyone who's willing to give it to me and then trying to figure out how I can give back to them. But many, and I have found that it's very important to have strong mentors, both in and out of this industry. I have many strong venture mentors. I mean, my partners are probably the biggest ones, right? I have 4 partners at USV, 4 investing partners, some other partners. They are all significantly older than I am. They have all done this significantly longer than I am. They've all seen a lot of success in it, and they are fantastic investors. And then it happens that they're also really wonderful humans. And I, whether they like it or not, and I think they do, they have been forced into core mentorship roles in my entire life. And so, that, I believe that one of the reasons as a young investor to join a partnership like this and to work with people like that is so that you can learn from their successes and their mistakes without having to make all of your own. And you can only do that if you really pepper them with questions and make sure you learn from both the things you got to witness and the things that happened before my time there. So I leverage them a lot in all kinds of ways. Dan Levitan, who runs Maveron, who I worked for a long time there, is a huge mentor of mine. He got me into this and is, I think, one of the best investors out there at mentoring young talent. He cares about it. He does it purposefully. And he, is really special that way. But even people outside of venture, my mom, who had a huge career, was general counsel of 2 public companies, served on many boards, balanced having a family and a very high pressure career, made that all happen. And now, particularly as I raise children, she's a huge mentor to me. And then a lot of my friends. I think sometimes mentors are people that are really far ahead of you age-wise or career-wise, and others are less so. And a lot of my close friends who I feel very in it with are huge mentors to me in so many ways.
I love that, Rebecca. And I appreciate the way that you think about mentorship as people who are ahead of you, who are also, shoulder to shoulder with you, who are personal and professional. Which is, I think, why Beyonce wrote a song about you, because I'm going to keep looping it in because it brings me deep joy. All right, let's get into it. We're about to talk industry trends, folks. Couple of reminders for our audience. Number one, if you have any questions, please drop them in the Q&A feature. Helps me organize my questions when I get to the Q&A section here in probably the next 15 minutes. And then also, if you are having trouble with the Q&A feature, just reach out to my wonderful teammate, Christy Lennox, our Senior Manager of Community, and she'll help you out. All right, so let's get into industry trends. What are some of the most important trends, Rebecca, you think that investors should keep their eye on, and why are they so important?
Yeah, so trends is obviously a big word, and we think about this. So USV, for a little bit of context, which helps inform how I look at trends, we're a very, very thesis-driven investor. So some investors look at it pretty opportunistically, evaluate companies out in the market and see what resonates, or are category driven. Maveron's very category driven, focus on consumer. USV is very thesis driven. So we spend a lot of time as a team focused on hypotheses of where we think markets are going and then investing behind them. We're not very opportunistic. Actually, all those strategies I think can be quite good strategies. It's just you got to kind of pick what you're going to do. Because of that, our trends are often less like healthcare or even AI, and more mechanics and market dynamics that we find interesting. So probably the one that I spend the most time on and believe is kind of most interesting right now is this idea of large pieces of our economy and large structures. Think the education system, the healthcare system, the financial services system, where you're seeing some cracks in the armor and some hairline fractures. And that doesn't mean they're going to change overnight, but our belief is how you shift them is to go outside in. And so we think a lot about where are there net new networks that can be built that are going to sit at the edges of industries and shift them from the outside in by putting pressure on the system without gatekeepers. So an example is a trend I'm very interested in is education. I think the education system in this country is at a real crisis moment, and we're starting to see evidence that there's openness on the learner side to making different choices. Our portfolio is really focused on direct to learner education. Duolingo, OutSchool, Quizlet, Fiveable, Sora, different businesses, actually quite similar in go-to-market and approach. And that's because what we're interested in is they're all going direct to learner, creating net new networks that sit on the edge of education and can shift it from the outside in.
I wanted to dig into this for just a quick second. How do you inform that perspective that you have? And so I'm thinking about this point that you just made, that there are these large structures that when you look at them, and education is a great example, and I'm a former teacher, so this is a topic I'm also really passionate about, seeing those hairline fractures and going from the outside in. What informs your perspective on that, and how do you continue to gather evidence to support that perspective?
Yeah, it's fluid, right? I think gather evidence, we're constantly talking to people. We're talking to, I spent a lot of time, another example is in healthcare and mental health, right? Like we have a big mental health crisis in the country, and we became pretty obsessed with the role psychedelics was going to play in it. Psychedelics is kind of on the edge of the industry right now. It's somewhat outside, somewhat inside. Ketamine is a completely legalized drug. It hasn't been utilized as much as it can be. It will be. Others are in the pipeline. How will this all play out to shift the market? And how can you do it without going and selling into healthcare systems? We talk to clinicians, we talk to practitioners, we talk to patients, we talk to academics, we talk to companies, right? We think sometimes the best information comes from those building, including those who failed so far, but might succeed the next time, but it learned a lot in doing so. One of the biggest ways we do it is through publishing what we think of as half-baked thinking. We aren't oracles. We are not experts. We will never publish the ultimate market map of X or the oration on Y market. We will publish hypotheses, and we will press ourselves to be very comfortable doing this in a half-baked way. These are our ideas. These are our thoughts. We're right on some of it, we're wrong on some of it. You tell us, let's think about it together. That is a core tenet that USV was built on, that was started by Fred and Brad, who started it, and is one of the things that's most sacred to it, because it's hard to get yourself comfortable with publishing half-baked thinking. None of us, it's not a comfort thing to do, but if you can do it, you invite dialogue and pushback and discourse that dramatically can move your ideas forward. And you also set your own thinking up to be informed. If you believe you're publishing the answer, it's very hard to be open to feedback and moving it. If you believe you're publishing a hypothesis, you're asking to move your own ideas. And that's, I think, a really powerful difference.
Fantastic. Thank you for digging into that, because I think it's so important for people to also remember that it's not a stagnant perspective that you have, right? It is constantly informed by new data, whether you're talking to like industry experts, like you said, people who've tried it, people who haven't tried it. And I just dropped what I believe is an example of what you're talking about, this piece that you wrote August 8th, Daybreak Series B. So pretty fresh, right? But I think it seems like a great example. Is that right, on the website, the USV website?
Yeah, that's actually a good example for a few reasons, because that is a company around, Daybreak is a company around pediatric mental health. And that's something that, as we've been very, very deep in studying the mental health crisis. We think it's kind of at the precipice between problem and true crisis, which for-profit, probably large businesses are going to play a major role in helping us move forward and solving. And it's massive. And there's so many pieces of it. There's pediatrics, there's severe crisis, there's proactive maintenance, there's Medicare and Medicaid. There's so many elements you have to treat differently here. And we've invested in many of them, actually. There's psychedelics, which I mentioned. Daybreak is about pediatrics. It's something we've studied for a long time. And one of our core hypotheses in our entire education portfolio has been not to sell through gatekeepers and not to go through schools. And as we dug into pediatric mental health, we kept coming back to the same thing, which is the way to solve this is to go through schools. And it was really an internal struggle. Okay, everything we've learned in one market suggests this isn't the right way to go, but everything we're learning in this market suggests that it is. And that's what we spell out in this piece, right? Which is how our thinking changed. It's not just here as a company. It's here's how our thinking has evolved, and here's why we got conviction in a strategy that differed for something we were pursuing before.
I love it. I love having a peek inside your brain here. And then also I love the way that you demonstrate the tension and the debate and the dialogue that you've had in the past versus what you're seeing in the future. I think it's such a great model. So thank you for sharing that, Rebecca. I want to talk a little bit more about these kind of bigger market trends that you're seeing, any of them that you want to dig into, whether it is education or mental health. But what excites you about some of the big trends or themes that you're seeing, and then what concerns you?
What excites me, I think, there's been massive software companies built that we can all think of, but the kind of pillars of our global economy have not shaken very much, which are kind of some of these ones that we were talking about. And I think you're starting to see that shake, and you're starting to see innovation penetrated in a different way. And that is really, really exciting to me. What frightens me? I think we have learned in the last, I think I have learned in the last decade and a half, probably others have learned before that, that technology is more complicated than we thought. And that, if you are a technology investor, the kind of natural disposition is to believe that all progress is good progress, and that all growth is good growth, because that's the incentive of our industry and our market. And I think we all now know that that's not true, and that it's all complicated. And that scale is the path to massive businesses, and also can introduce societal problems that probably were not foreseen at the start, but maybe could have been, and maybe should be the next time. And that is something we think a lot about as a firm. How can we back and support companies that are going to reach absolutely enormous scale, but can also create societal impact that we are proud to be a part of?
Yeah, I actually wanted to dig into this just a little bit more. So, I've seen this this conversation comes up a lot around AI, I think very naturally, right? And then as people look back at social networks, for example, and what's happened with social networks and what we've learned from that and how we can apply that to AI, I'm curious for you how you think about mitigating some of those concerns in the future. Do you think those are, big conversations the industry should be having? Do you think it's a firm by firm? Do you think it's company by company? How do you approach that conversation?
So someone in the chat said, was I referring to AI? I'm not really referring to anything. I think AI actually has the potential for enormous benefit, right? I think AI on its own doesn't scare me. I think applications of anything, applications of social networking can be amazing and create massive connectivity and belonging, and can be scary. Applications of AI can be incredible. We're invested in some, we believe in some, and can be scary. And so it's all about the way the applications are created and managed. One of the ways we think we could course correct or chart a different course than we have is actually around data privacy and data control. That the market has learned a lot. USV has our core thesis around network effects, and data is closely connected to that. And what we've learned is that without any data control, data aggregates into power centers, and that has a lot of problems associated with it. And so we believe one of the biggest opportunities in this next cycle of innovation is to make sure the end user has control of their data. And that as innovation is built, it's built with data controls in it in a different way. That's one very core thesis of the fund that, we're quite excited about.
Yeah, that's a perfect example. And I appreciate you diving into that a little bit more. Let's talk about trends for investors right now. So what do you think success looks like for investors now versus in the last few years?
Well, I mean, there's kind of a couple of answers to that question, right? On one hand, success looks the same. Success as an investor, one of the things I love about being an investor is like success is really clear. It's DPI, distributed returns to RLP base. Good market, bad market, any market, that is the goal of what we're doing, right? And so success will look like we raise a fund and we multiply that fund net to our LPs. The way you get there varies market to market, right? In some markets, you're right, you have these hype cycles to deal with. They're good and bad. You have much more capital in the market. That is proven to be good and bad. So you're managing a portfolio, getting to that ultimate goal in a different way. This market, I think, is a lot about discipline and patience, right? Like, I think there's a dopamine hit as an early stage investor to your portfolio constantly raising money, whether or not that is actually a good thing to happen, right? Like, you make an investment and then 9 months later, 6 months later, 12 months later, some other firm comes in and gives them more money, higher price. And you are like, all right, here's a data point that whatever I did was good. That may or may not have any relevance, and it may or may not be true, but there's a dopamine to it when you're dealing with long hype cycles. And what we're all learning now is how to live with our own conviction without that dopamine hit. Ultimately, that might be quite a good thing, but it's a different kind of investor cycle that we're in.
Live with conviction, with that discipline. I think, woof, I think that's such a great way to explain it. And I want to dig in a little more about challenges you think that investors face in this market, maybe around that discipline, like you said, or maybe not getting that dopamine hit as often. What do you think?
Yeah, look, I think one thing I've really learned from my partners, particularly at USV is a firm, and my partners are certainly people that are known for, they don't really care about the market. They don't really care what the market says. They don't really care what the market does. And it is easier to do that the more established you are. It's very hard to do that as a rising investor, right? Because we're human at the end of the day, you know, whatever else we want to be. And it's hard to block out the noise. But I learn a lot from them on it, because something I very much believe is you could be an okay investor chasing a market, but you're never going to be a great investor chasing a market. And you're going to be a great investor if at certain moments in time, you make high conviction decisions based on your own thinking and hypotheses, hopefully which other people don't believe, and turn out to be right, right? And every major success at USV in its history basically follows that narrative. And so USV is not a firm that has seen success by getting into the hottest deals at the hottest times. It has seen success by my partners having strong beliefs that turned out to be right before other people believed them. And I love that. I think it's extremely hard to do. But when I think about doing this job for the next several decades, which is my aspiration, it's also a really fun way to do it. And it's a hard way to do it. And it's, I think, rewarding. So I think that's kind of, this market is emphasizing that importance.
I really want to applaud you for, first of all, sticking around for a long time. We also want you to stick around for a while. We're very excited to see. And also, what I love hearing from you right now is that the hardest decisions are the ones to make where you're unpopular, but those also have the potential to have the biggest upside. And leaning into what you believe firmly, strongly, even though other people tell you that's not right or that can't be possible, is such a tricky thing to do, but it presents opportunities, which shifts me to my next question. What are some of the biggest opportunities that investors can take advantage of right now?
Well, I mean, from a process perspective, a bunch of things, right? If you think about where we were, 18 months ago, we were running sprints at every opportunity. You had very little time to process things. Everything was kind of priced to perfection. And you often, met a founder and then had to make a decision in a very quick time. I think it's always important in these conversations also to say like that these are generalizations and they're not universal. And particularly, I have a lot of female CEOs who I work with in my portfolio who like to say like their time is now because like all of this, hype that other people were talking about how easy it was to raise money and how they had, term sheets thrown at them 18 months ago was never applicable to them. And so, other people are having to like whiplash on, oh, how do I run a business in a different market? And they're like, it's same old for me. Like, let's go. My time is now because I'm ready for this. So I think it's easy to generalize things, but it's not, universal across a market by any means. And oftentimes women have had a harder time accessing capital and even in the hottest markets. But I think, as an investor, you do have more time. You have more time to do the work. You have more time to do the references. You have more time to get to know the team and for them to get to know you, which is equally as important. And so when you start the relationship, you're starting on better footing and more transparent footing, and you just have a deeper network of trust. I think that's all been really positive, and the entry prices are really 50% of what they were overall. And so, it's a early stage investing it's a good time. And I believe for some of the reasons we spoke about earlier in the conversation, we're seeing tremendously interesting opportunities emerge. You also have a talent network that's extremely strong. You have people who have been at large platforms for a long time where it's been really hard to leave, who are saying, I'm done. I don't want to be here anymore. And the reasons I had to be here are less than they were. Or you have people who are sitting at companies that they thought were kind of imminently going public. Now they're not. They're going to jump out and, try something else and start that company. So I actually think it's a very good time as an early stage investor from the entry points.
I love that. And I also want to point out, I love that you're like, I've bet on women before, and I'm still betting on women now. And when I saw the Female Founders Fund report, I want to say it was in April, where they talked about the fact that women operate with 25% less capital compared to their male peers. It's just so interesting to see how women are able to weather these storms, because they've always had to be resilient, which is the same for marginalized communities, right? They didn't ever
Absolutely.
have access to that level of capital. So they always had to be capital efficient.
And now that's an advantage, right?
That's an advantage. That's an advantage. That's right. Rebecca Kaden, that's an advantage. All right. So I want to talk to you a little bit about deals. And this is also something I'm geeked out about, because again, like I've listened to you talk about technical terms and deal flow. Like I'm very geeked to talk to you about what investors should be looking for in deals right now.
I'm not sure that varies that much in the market. What I look for in deals, number one, I look for a founder who's unstoppable, who I believe is extremely tenacious, has extremely large vision, can balance this big picture ambition of this massive platform they want to build to change some market, and also the detail orientation of what it's going to take to get there, who is an exhibited talent magnet. That doesn't have to mean they've run a company before, they've hired into that company before, but there's some evidence that people like to work for them. That doesn't mean they even have to have hired them full time, but you want to look at them and say, wow, people just gravitate towards you. You have an advantage in bringing strong talent on board. You do want a why now and a why who, right? So why are you best advantaged to win this market at this moment in time? There's almost always competitors. In any good market, there's many competitors. And so you want kind of innate advantage involved in it. And then for us, it's a lot about, is there alignment in thinking of a thesis that we're excited about? And that's true, all the time. There's going to be many great companies out there that we're not a part of. And we've structured funds where we're totally okay with that, because what we're looking for is alignment in thinking in a pretty narrow bands of the things we are very focused on.
Fantastic. And folks, I want to remind you really quickly that we are headed to audience Q&A. So please drop your questions in the chat. Try to keep it to one question and keep it as brief as possible. I will get to as many questions as I can. But before I shift over to audience questions, Rebecca, I'd like to talk to you about investors who are raising funds. How do you think they should adjust their strategy to account for what's happening in the market today?
I think a couple of things. I think one, the biggest is probably, and this is what I've never been a new manager. I've only joined platforms that are established. So I always like to caveat that with giving advice on this, because I think it's enormously hard to raise funds as new managers. And I admire it so much, and I don't have firsthand experience doing it. I've just watched a lot of friends do it. I think the first is to have very realistic time expectations and give very long lead time to it. I think LP conversations always take a long time, but particularly in this market, are taking a very long time. They want a lot of lead time. They want a lot of time to see things prove out. And so start them quite early. I think the second is the more you can prove before you have institutional capital, the better. That doesn't even necessarily mean writing the check, but showing that you've been able to get in front of the right founders, help them in some way, become important to them, develop that network. And particularly if you haven't been an institutional investor before and you're raising an institutional fund, I think the more you can show versus having to kind of extend belief on the LP side, the more, the better it's going to go. And then I think, realistic expectations on size. I think funds that were bigger a year ago are smaller today, and just believing that if you can raise that first one and show some proof points, it will create an open door to raising a bigger one the next time.
That's fantastic. I really appreciate you keeping it very 100 with us. And guess what? It's time to head over to audience Q&A. So I wanted to get into a few questions. Just a reminder, folks, if you have questions, drop them in the Q&A feature. If you're having issues, please reach out to my wonderful colleague, Kristen. She will help you out. So the first question actually comes from Pian Pian. She says, Rebecca, what do you look for when evaluating investment opportunities? I'm the founder of Emotions that improves managers and teams' productivity with the AI-powered upskilling and coaching. What stage do you invest in, and what's your typical check size?
Sure, I'll do the last one first because that's the most straightforward. USP, we manage 3 pools of capital. Primarily, we're early stage investors. We lead Series C and Series A checks. Rounds, we write checks in that fund of kind of like 1 to 10. We do them almost always post product and often post initial customer feedback. We're not looking for a product market fit, but we rarely do pre-product or pre-commercialization unless it's very up the alley of something we're very particularly looking for some reason. We also manage an opportunity fund where we do slightly later checks. We think of that very opportunistically. We're not out there kind of sourcing growth deals, but when we have a thesis and the natural fit is for a company that's later, we do it there. And then we manage a climate focused fund, same 5 partners investing in each of those 3 vehicles. What do I look for? Much of it is what I said before around the people side. I think that's where you start, and then alignment and thinking on our thesis. Those are the top 2 things that I start with in evaluating anything.
Thank you very much for the question. Thanks for being clear and direct, Rebecca. I have a question from an anonymous person, which, by the way, you can submit questions anonymously. So if you're like, I really got to ask this question, but I'm not sure I want to attach it to my name, get out there and be anonymous, y'all. So this question says, which emerging fund managers inspire you the most?
Ooh, I love this question. Lots of I think some of the emerging fund managers out there are building platforms that might become, extremely pivotal to venture. Lots. I admire what Taylor and Byron at 12 Below are doing in New York City and their coverage of that market, or what Pace Capital is doing in New York City and the coverage of that market. I admire what April and Jess are doing in California. They're both legendary operators who have really, really flexed that to the investing side and are building an awesome platform. I admire what Aileen's done with Cowboy and how she's built that brand and that platform, so well. I just think, venture favors the hustle and the hunger, and some of these are in front of so many companies and so many founders and just, working really hard for their portfolio. And so I admire them a ton.
Thank you for sharing, Rebecca. Heading on over to Elizabeth Monroe. What role do you think VC will play in addressing your concerns about how tech is used in things like data privacy and AI? Could VC address your concerns in addition to regulation? Or perhaps VC could move faster than regulation? Very curious to hear your thoughts. I'm going to drop this question in the chat for you. Go ahead.
It's a really good question. I think ideally VC and regulation. So we've always believed USV has actually worked pretty closely with Washington and some pieces of regulation on things that matter to us. We tend to be pretty active there. And our belief is that regulation serves a very important role and should happen even in markets like crypto, which we've been very active in and has a lot of different. But we've always believed The move is to regulate it, because you're never going to attract the best talent if they can't trust that they can build in a space in a clear way. What that regulation is matters, and it often is slow. And so where I think it works hand in hand is venture for software companies can be an early gatekeeper in terms of what gets funded and how it comes to market, and some of the publicity it can get, and pushing things forward in early ways. And so if you want to see something in the world and you believe it can be a good business, a good way to support that is to fund it, and then to hopefully work with regulators on it as well. But we think VC plays a big role here.
Fantastic. Thank you so much for the question. Heading on over to another anonymous question. Are you always super direct and honest when you pass? And I'm guessing pass on a founder. Should founders take passes seriously? What are your thoughts, Rebecca?
Good question. I try to be very direct and honest when I pass. I find, look, I always say to founders, like, we're all trying to help each other here, right? Like, you're spending your whole life building a business. My job is to spend 45 minutes and decide if it makes sense for USV to really dive into this or not, based on our hypotheses and alignment. There is no way I can know that, right? The idea, one of the reasons why I like thinking about it as alignment to our thesis, and why I like thesis-driven investing, is I've always really struggled with this idea of investors looking at a company and being like, is it good? That's an absurd, foundation to decide anything off of. I don't know if it's good. You're building the company and spending your whole life on it. Like, I'm thinking about it, in the scheme of things, pretty briefly to start. You know if it's good. I know if it's aligned with what we're interested in and it makes sense for us to dig in on. And that's what I'm going to tell you. And so we are very, very direct around, here's what we do, here's what we're focused on, here's where there's overlap, here's where there may not be.
Fantastic. Thank you so much. Going over to Anne, for a first-time female founder bootstrapped with a 3 years of revenue and traction for an ed service company that's been launched and thriving. What's the right approach to raising a seed round for the underlying tech build that will scale it even further? And is the timing right for it this fall?
I actually think that this fall is going to be a totally fine time to raise money. I think there's a lot of capital sitting there. There's a lot of interest in things going on in the market. The public markets currently look pretty good. We're just kind of on a wild ride tracking what's going on in public markets, and venture does trail that. And so I'm telling our portfolio, if you're at inflection points and you've been waiting for a moment where you believe there's market opportunity, go get them. I'm not sure that it makes sense to wait. When is it the right time? Obviously hard to know without knowing a lot more details of your company, but when you believe that there's inflection to the story that you can tell, that's what you really want to raise around. When you believe that you're seeing some difference in the slope, that you can go tell a narrative around where the capital is going to accelerate the difference that you're seeing.
Yes, I love that advice. In a similar vein, this person who's anonymous says, where do founders go wrong in the raise process?
Wrong is the wrong word, right? It's like the raise process, especially if you've never done it before, it's like, throwing someone into a horse race who's never been on a horse, right? It's like kind of hard expectations. And so give yourself a break. We're all figuring it out. But what are some pitfalls that you can look for? Manage the process tightly. So get all your material together, figure out your story, make a list of the people you want to talk to. Probably the first place people can stumble is on that list. If there are founders that have never invested in the stage that you're in, or don't often invest in the stage you're in, or don't often invest in the category that you're in, it's extremely unlikely that you're going to be the first one. And so you're wasting your time by trying to convince them to do something that they don't do. And so you really want to manage that list in your time to the highest likelihood with demonstrated evidence that they have interest in the stage and the type of company that you are building. You do want to pay attention to the intro. Many of us wish that wasn't the case, but let's be realistic that it is. So stack ranked. People in their portfolios, definitely number one. Other entrepreneurs is a good one. Down the list are investors that could invest but aren't. Not a great intro. There are great cold emails out there. I've invested off of cold emails, but it's less likely than from a warm intro because people's inboxes are crowded and the signal issue. you want to kind of run the process tightly, and you want to tell an aggressive story, but not overplay your hand. You don't want to say you have term sheets if you don't have term sheets. You don't want to give artificial timelines if they're not real. It's all tempting to do, and there's advice around out there, but particularly in this market, people will just walk away. And so you want to try to create senses of urgencies, but do that in an authentic way. And I would say try to build authentic conversations with the people you talk to, because it's easier to get excited if you've done more than gone through the deck. And so if you can get off script and you can have a conversation versus pitching slide to slide, oftentimes it will create more emotion and more excitement from the person you're pitching.
Yes, and that was a very clear strategic advice. If you didn't catch that, we will have a recording afterwards as well. So thank you for the question. I want to shift back to advice for investors. So I've received some great questions about it. One in the Q&A feature: how do you keep your energy and passion for VC high despite the challenges in market cycles?
Hard. I mean, and I don't know, some days I'm like, this sucks. But
yeah, Real Talk Tuesday. I love it, Rebecca. Sometimes this is terrible.
Sometimes I'm like, oh, I cannot. But I mean, portfolio helps here, right? Because at any time there's stuff to be really excited about. And the magical thing about being an early stage investor is you're constantly focused on the excitement of the potential of the new, right? So like any market cycle, there are people out there who are awesome and crazy smart and interesting, talking to you all the time about how they're giving their lives to trying to, move the non-existent into the ubiquitous. That's a crazy thing to do and to be a part of. And so there are times I feel exhausted by the whole thing, but then you have a conversation inevitably that you're like, this is wild, whether or not even it's a fit for what I do, or I think it's a great investment, like this is wild and it's awesome. And it being around people like that is contagious.
Yes, I couldn't agree more with you. I think that's the exciting part, right? And also, like, when you talked about grounding yourself in your portcos, I think that's such a great way to stay grounded and also excited, because they're making progress every day. They're serving people every day. They're solving the problems that you exist to fund, right? So, but it's also hard. So in a similar vein, what do you think is your best advice for investors who are just starting their careers in this market? And I also want to give you a little bit of context. When we were out on our 7 strategy tour, we heard from a lot of investors who had kicked off their career, women investors in particular, who kicked off this career during this like influx of hiring, right? And now things are different than they were then. So what advice do you have for folks who are just starting out, and how can they be successful?
Take your time. I feel a lot of urgency to return and multiply capital, not to deploy it. Very different. Feel urgency to create returns, not to make investments. Very hard to do when you're starting your career, because there's no way to create returns without making investments. But take your time. Be patient. Learn from the investors you work with. I'm an investor that came up the ranks of venture firms that have I'm a believer in the apprenticeship model. It has paid dividends for me. There are lots of ways to go about this, but if you're someone who's at a firm and the path up might take longer now than you thought it would when you started, soak it in. Learn. They're having conversations right now at the firm that are so valuable that will really serve you for the rest of the career, around portfolio construction, around portfolio management, around how to support companies in harder times, when to do it, when not to do it, how to work with founders, how to communicate with them, including around hard topics. A lot of things you heard a lot less of in the boom time, and that's really going to make you a really awesome investor. And we run this like small equal partnership, but I'm just doing it all the time with my partner. As I was emailing our team about a company the other day, and one of my partners, Fred, wrote back to my email just to me and wrote, what I hear you say is it's time to lean in. These hard decisions are what makes or breaks great investors. And it's such like an amazing reminder of like, you're managing so much, you're going through things, but making a non-obvious choice right now, which I would only be able to do because of the market we're in, is a moment to differentiate. And you're going to see these now in a way you just wouldn't when you were just hired to chase deals. So it doesn't feel like it, but it's actually better in a lot of ways for you.
You have such great advice about how to use this time as an opportunity, right? And not as a frustrating experience where like, I'm not moving as fast as I could. I wish I could move faster. Do you have advice about other ways that investors can sharpen their chops right now by building relationships outside of their firm? Who else should they be talking to, learning from? What
It's a
should they be
great
reading?
time. I always say, like, one of the best things I did when I was starting in venture was develop a very, very strong cohort of my peers outside of my firm, particularly other women, but also also men. They're now like lifelong friends, but and confidants. And actually, like, some of those groupings and conversations eventually led to starting All Raise, that we would have lunch all the time. And then eventually it kind of bled into All Raise. But they were invaluable when I was switching firms and needed a lot of advice on how to manage that conversation. They were invaluable. And, a lot of us had kids around the same time, and we spent a lot of time talking about how to, balance those things. I throw questions at them all the time about companies I'm looking at in extreme trust. Like, I think developing those relationships pay a lot of dividends, many in ways you can't expect, and is very worthwhile. And the other thing I would say you can do now is like spend time on thinking. What do you care about? What do you believe should happen? What, not a deal. This is something we really believe at USV, that you should have dedicated time in your schedule on a weekly basis, hopefully on a daily basis, that it's not about deals. It's not about portfolio. It's not about new opportunities. It's about ideas. And that's going to make you better at both when you're working on them. And so if there are less deals going on, overweight the thinking time.
Ooh, overweight the thinking time. It never seems like there's enough time to do that. So if you got it, take it.
Yep.
One of our last questions I'm going to ask you came from Jessica McAntee. I apologize if I mispronounce your name, before the session. And she asks, what type of liquidity opportunities are you seeing as IPOs have seemingly paused?
Yeah. Couple of different things. We're seeing opportunistic M&A. We were early investors in Casetext. They just sold to Thomson Reuters. Those kind of things are happening, not at the velocity that they were, a couple of years ago, but you're seeing opportunistic M&A. There's some people who believe we're actually about to see a lot more than that, because of kind of the dynamics of companies looking for new growth channels. USV has always been deep believers in secondaries on the way up. We believe if you do it consistently, you return money to your LPs a lot quicker, and you eliminate the signal risk with entrepreneurs if you're just very kind of systematic about it. USV has always done that, and we continue to do that. There's still liquidity opportunity that we experience in crypto in that portfolio, which is about 25% of our portfolio, but it's a different cycle, right? If you look at the liquidity of, 18 or 20 months ago and then of today, it looks really different. And so part of it, I think, is just going to be exhibiting the right patience.
Yeah. Patience and discipline. That's what I keep hearing from you over and over again. All right, so we're heading into our final questions here. First, Rebecca, I just want to thank you, and I want to point out that Kat in the chat says, I'm a former journalist who got my MBA and is now working in climate space at Emergent, and just wanted to say it's so cool to see a journalist turned investor. So you are shining a light for other people. Just want to call that out. Kat, thanks for being here, and thanks for bringing that up. I hope that makes you feel good, Rebecca.
It does. I love it.
Hell yeah, great. So thank you so much for your time today. I want to get into your final advice. And so we have a lot of investors and founders and operators in the room today. And my question for you is, what is your final piece of advice for them as they embark on their journey after the session?
I think I have two. One is investing is a really long game, right? It's actually a pretty bad job to do in the short term and a pretty good job to do over the long term, particularly early stage investing, just because of the time cycles involved. And I don't think anything is sustainable, or particularly over that period of time, if you don't find what you love about it. And I think spending the time to figure out, invest in things you love, like invest in people you love, invest in things you're excited about, invest in problems you want to solve. Believe that there are lots of great businesses out there that can be built that you don't have to be a part of. But if the ones you do decide to be a part of are awesome, that will create a very, very, very good career. And that will only happen if you are passionate about them. So that's one thing I definitely believe. And the other is we're in an industry as investors where helping each other and developing great community is self-serving. that is not often the case. But we're really lucky for that to be the case, where the more we help each other, the more we can invest in each other's deals, invest in each other, build each other up, show each other opportunity. We rise from doing so together. And the fact that that's the case is super special, and it means we should lean way, way, way more into it than we do. And so when you have an opportunity to do so, take it.
Rebecca, I'm so grateful for you, both for your expertise here today, but then also, again, for the work you do at All Raise. You are such an important member of our community, and you're also an incredible mom. You are an incredible friend and family member. So just keep shining. We're here cheering you on and supporting you.
Thank you for having me.